central bank policy decisions, scheduled announcements from 29 members of the FTSE 100, and quarterly results from 164 members of America's S&P 500 index mean it's going to be a very, very, very busy week. So to start with those central banks, on Tuesday the 30th of July, economists expect the Bank of Japan to leave its headline interest rate unchanged at minus 0.1%, to stick to its plan to cap the 10-year government bond yield at plus 0.1%, and do so by using its 80 trillion yen a year quantitative easing scheme. Do note, however, the BOJ has actually been undershooting its QE target for this year so far. On Wednesday the 31st of July, we've got the big one with the US Federal Reserve. As I sit here, markets are putting a 77% chance on a 1/4 percentage point cut and a 23% chance on a half point. Action is seen as certain. The issue then is, do markets A, rejoice as they feast off more cheap cash, B, pause for breath after a good run as the policy move's already been well flagged, or C, run for the hills because they decide the need for rate cuts mean an economic downturn is coming. Then, on Thursday the 1st of August, we have the Bank of England. Wage growth is accelerating and unemployment is low. But on the other hand, Brexit's on the horizon, so maybe the chances of Governor Carney and colleagues sanctioning a change in the headline interest rate of 0.75% or the £435 billion QE programme, well, they still seem slim. If anything, the bank may even now start to ease towards cutting, not raising rates. Anyway, the chart here shows headline interest rates at all three central banks. You'd have to say that attempts at a mild tightening of policy look to be faltering. The second graphic then shows the number of rate rises, the line, compared to rate cuts by month since the start of last year at central banks around the globe. According to the website cbrates.com, we've had over 40 central bank rate cuts this year, with Russia, Korea, South Africa, India, Australia, New Zealand leading the way, and that compares to just 10 increases, with Norway the most prominent exponent of tighter monetary policy. That compares to last year's totals of 89 increases and 47 cuts, so the tide looks to be turning. Company-wise, news flow is going to be plentiful in the form of results, trading statements and annual general meetings. Names which may be worthy of note, either in their own right or because of the read-through they provide on the UK or global economy, include the following. FTSE 250 Real Estate Investment Trust Hammerson, National Grid and Hiscox on Monday the 29th of July, Reckitt Benckiser, BP and Centrica on the 30th, and I note the Sunday papers are now starting to talk about a dividend cut from Centrica as a possibility. Lloyds, Next, Taylor Wimpey, BAE Systems, Direct Line and another REIT in the form of Intu, as well as recent flotation flop Aston Martin Lagonda on the 31st. We've then got Royal Dutch Shell, British American Tobacco, RSA and Rio Tinto on Thursday the 1st of August. And finally, BT, International Consolidated Airlines and Royal Bank of Scotland on Friday the 2nd. But for me, for all of those, the stock most likely to cause a big fuss in the week ahead is another bank, not Royal Bank of Scotland, but Barclays. It's due to release its first half results on Thursday the 1st of August. As we can see here, the shares have continued to grind lower, and they have, so far at least, taken little comfort from the board's success in fending off activist investor Edward Bramson and his plan to allocate less capital to Barclays Investment Bank. All in all, Barclays shares are not much higher than they were 3 years ago in the aftermath of the Brexit vote, and the FTSE 100 has gained something like 10 to 12% over that same period. To see if Barclays can galvanise its share price, analysts will be looking at two particular headline figures, pre-tax profit and the dividend, but they will then dive behind those numbers to look at three trends which may shape current and future performance. So to begin with those, in terms of the headline pre-tax profit number, Barclays made £1.7 billion on a stated basis in the first half of 2018, so that's your benchmark. On an underlying before bad stuff basis, it actually made £3.7 billion. In the second quarter only last year, Barclays made 1.9, but as we can see from this chart, the figure's a pretty volatile one. In terms of the dividend, well, Barclays paid 2.5p a share at the interim stage and a 4p final for a total of 6.5 pence a share last year. Analysts are looking for 7.4p for the total this year, so that's an increase, so one assumes they'll be looking for a hike in the interim payment as well. Now those numbers will help to measure quantity of profit. 3 more will define quality, and here we must look for the devil that lies in the detail. First, analysts will be looking to the level of restructuring costs, loan impairments and litigation and conduct charges. Since 2013, that little lot's cost Barclays £32 billion, more than double its total pre-tax profits and 6 times more than it's paid out in dividends over the same period. This trio cost Barclays £2.5 billion in the first half of last year, but just £371 million in the second quarter. But with the deadline for payment protection insurance claims coming up, might see a final spike there, so let's see. Then move on to the net interest margin. This measures how profitable Barclays' loan book is, as Barclays will borrow money in the short term or attract deposits at one interest rate and then loan out the cash at a higher one, at least in theory, over the longer term. It'll then pocket the difference as profit. The problem that we've got now is that as central banks look to cut headline interest rates, the yield curve is flattening, and the gap between short and long rates, that is narrowing. That squeezes the bank's net interest margin and hurts their profits. As we can see here, Barclays is feeling that squeeze, and its net interest margin in Q1 was just under 3.2%. Finally, watch the mix of profits and especially the performance of that investment bank. Chief Executive Jez Staley and the board are committed to it, so this operation must perform. Note that in 2018, the investment bank controlled 56% of group equity, but made a return on that equity of 9.3%, compared to a 16% return on equity at Barclays' UK business and the other operations. In the first half of 2018, the investment and corporate bank did make a pre-tax profit of £2 billion, I must say, but as we can see again, the quarterly trend can be volatile, just like financial markets. Thank you for watching, and I look forward to seeing you next time.